This is the 401k Fridays podcast, and I'm your host, Rick Unser. If you're a retirement plan fiduciary or administer your company's retirement plan, you've come to the right spot. Our format is pretty simple. In each episode, we select a timely and informative workplace retirement plan topic, we pick the brain of an expert guest, and provide you the hard-to-find perspective you need to make informed decisions that benefit your plan, your employees, and company. Now here we go with this week's episode. If you have stable value funds on the mind, my conversation today with Debbie Vince and Ken Sommers at New York Life will certainly answer most, if not all, of your questions about stable value. We start with a conversation with Debbie talking about some of the basics of stable value funds. What is stable value? How do they work? What are some of the unique attributes of stable value funds versus maybe some other cash equivalent strategies that are in retirement plans? And then we move on to Ken and talk through some of the unique challenges and realities of investing stable value fund assets in the market environment today, which is really highlighted by exceptionally and all-time low interest rates. Great conversation. And if we missed anything, I would love to hear your thoughts. Shoot me an email to feedback@401kfridays.com and we'll get you an answer. Before we get started, if you've been enjoying the podcast, please, as we go into the new year, take a minute and share it with a friend, a colleague, or anyone that you think might benefit from it. You can just have them search 401k Fridays on their favorite podcast app or send them to 401kfridays.com. And there's all sorts of options there to listen to episodes, subscribe to the podcast, and more. That's it. I hope you enjoy my conversation with Debbie and Ken. Well, Debbie, Ken, thanks for joining me today. I can't wait to hear what you have to say about all things stable value. So thanks for being here.
Thank you.
Thanks, Rick.
So, Debbie, do you want to just introduce yourself real fast, and then Ken do the same, and then we'll jump right in?
Yeah, sure. Thank you so much for your time and for doing this. Appreciate it. I'm Debbie Vince. I work at New York Life, and I'm our sales director for the West region, covering all things stable value.
Awesome. And Ken?
And I'm Ken Sommer. I'm a managing director and senior portfolio manager at NYL Investors, and I've been managing stable value funds for just about 10 years now. So look forward to giving a little bit of color on fixed income markets and particularly how that affects stable value funds, Rick. So thanks for having me.
Awesome. And there's a lot to talk about, both on the nuts and bolts and on the portfolio management side of it. So without further ado, we'll get us moving along here. So Debbie, maybe just kick us off with, to some, stable value is a term they haven't really come across in the past, or it's something that they're maybe not quite as familiar with. So when you think about stable value, I guess at a high level, what does that mean and what should people know?
So I would say stable value is a type of capital preservation fund that resembles a money market, and it falls on the risk spectrum as a conservative option for participants. It has the same types of things that money market has with the liquidity, so participants can move money in and out. Historically, we have seen higher returns in stable value than money market, and that's really due to the high-quality portfolio bonds that make up the stable value fund. And then the difference really is that there's guarantees with stable value. So those guarantees are backed by banks and insurance companies, so that participants don't lose principal or interest.
And that's always kind of an interesting word in the world of investing and in the world of 401k plans. So, when an employer gets that, hey, I want to put my money in something that won't lose money, that inevitable question that comes in from an employee, is there, I guess, an advantage or anything that a stable value fund brings over maybe other options that are potentially on the lineup?
Yeah, I think those guarantees really matter, particularly in the environment that we're sitting in today with very low interest rates and this concept that we're going to be in a place low for long. So having basically a bond experience without the volatility can really bring some additional value for a participant. We're starting to see, because of the compressed interest rates, some money markets are actually returning a negative return, because if you think about the expenses and the low interest rate environment, it starts to eat into yield.
Yeah. And as you start thinking about this, I know a lot of people, whether it be in an IRA or in a brokerage account, are going, man, I wish I had a better choice or something else to invest in that might provide a little bit more of a rate of return in a very kind of safe environment. Can they get a stable value fund individually in an IRA or in a brokerage account outside a 401k plan?
Unfortunately, no. And trust me, we have definitely looked into this. We'd love to open up the gates and allow individuals to utilize these types of funds, but they are designed for qualified plans. So you can only use them in 401ks, 403bs, defined benefit plans, cash balance, things like that. And it would be wonderful. And it's definitely something to think about when you enter into your retirement years. Should you be pulling money out of a 401k? Because you do have potentially that option available to you, and you can't get it outside of your plan.
As we think about that qualified plan environment, the workplace retirement plan world, as I kind of call it, I feel like a lot of people understand, okay, I have a money market account. Like that's something I feel like a lot of people get. And then there's some people say, oh, well, you should consider a stable value, or, hey, how come you're not using a stable value? But before we go too much farther down that path, I mean, is that really the kind of the binary choice there is if you're looking for that capital preservation or that cash equivalent option? Is it just binary for plan sponsors between money market and stable value?
We still see a lot of utilization where they have both. And to your point, Rick, I think that it can be rather confusing for participants when they offer both a money market and a stable value investment, because they really are truly designed to meet the needs of capital preservation and say it's where their safe money is. So I think making a choice on which fits best into your plan and for your employee base makes it less confusing.
And as an employer, when you start thinking about money market or stable value, I think the knee-jerk reaction is, well, I want to give my participants the best opportunity to earn yield. And, Debbie, I would agree with everything you just said there, where money markets are in a very challenging spot right now, just based on where short-term interest rates are. And when you look at the yields on stable value funds comparatively, a lot of them are in the ones, in the high ones, if not in the twos. From a yield standpoint, you're going, I'm going to get either zero or next to zero, or I'm going to get something positive. Seems like a pretty clear choice that stable value might make more sense if you're just looking at yield. Is that a fair way to kind of think through the pros and cons of money market and stable value, or is that too simplistic?
Well, I think oftentimes because this is an asset class that isn't understood as well, and many advisors and investment committees have kind of steered away from doing a formalized due diligence on this asset class. But it's important not to chase yield. I think there's so many more components that really go into this that, you need to look under the hood. So for instance, historically, if you just look at money market returns versus stable value, just because of the nature of the portfolios, over time in a full market cycle, stable value typically outperforms money market. So one could argue that that's a better option for participants over time. Does it mean that money market will not outperform stable value at some point? Absolutely not. You've got things like duration, and so in rising interest rate environments, money market is going to react in a positive way faster. But in declining rates, the opposite can happen. So it really is a matter of looking at things like who's insuring the guarantees in a stable value fund, and then taking a little step further, what are those financial ratings that insurance company that's providing those returns, what do they have for a financial rating? What's their reserves above and beyond what is required by them compared to liabilities. And then looking at historical performance and termination provisions. So there is a lot that goes into analyzing what's the best option for our plan.
I guess just to put maybe a finer point on it for a second, when I think about a money market versus a stable value, and I think you said this very early on, but maybe just to reinforce, a money market is going to be very tied to short-term kind of Fed-driven interest rates, whereas a stable value fund is going to look a little bit more like a bond portfolio that has some guarantees and other components to it that will provide a little bit more of a smoother ride than if people were just investing in a portfolio of bonds or a bond mutual fund for their sort of principal protection type strategy. Is that a good overview, or is that a good kind of summation, just to like as we think about like in complexity and how, coming back to the point about yield, where if you're just looking at yield, it's just kind of a surface deep level of analysis?
Yes. So basically, stable value funds have much more diversification in what they're investing in. So you're going to have a percentage in corporate bonds, asset-backed securities, mortgage-backed securities, commercial-backed securities. So you want to look at, how much cash are they holding? Because obviously in this environment, cash is not going to provide much yield. And basically, to your point, yes, money market is investing in very short-term treasury-like vehicles. So you're just not going to receive the same yield that you would in a stable value fund due to that diversification. And so that's another component in looking at what's going on in the market and where's the portfolio, investing those assets.
Yeah. And I think this is where things in stable value conversations can get complex pretty quickly. And having had a lot of these conversations over the years with employers, I think some people will say, hey, after everything you just said, I kind of like the simplicity of money market. My participants understand it. They see a money market account maybe at their bank or in their brokerage account, and they get it. And I don't know, as I think about stable value, it just seems too complex. There's too many moving parts, and we'd rather go with the simplicity. So I guess I would imagine you've heard that as well over the years. What would you give an employer maybe as a couple additional thoughts to kind of help them get comfortable with stable value if they are, let's just say, not super attracted by money market yields, but the simplicity seems to make sense?
Well, I think it's important, particularly in our environment today. We're seeing more litigation around capital preservation and the choices that plans make. And one of those, we saw a lawsuit that settled for $17 million that was due to the fact that they were sitting in money market and didn't look at their other options. And they did basic math. They could have earned, I'm just going to use simple numbers. They could have earned 2% and they only earned 0.25%. And they took the actual value of that loss, and that was the settlement. So it is important to look at options. And of course, from a fiduciary standpoint, there is no right or wrong. It's more about the process and documenting why that plan sponsor decided to stay in money market versus stable value or vice versa. But it is something to definitely consider in our high litigation times that we live in today. And I would say that another reason why it's so important to have an advisor help them through that process when looking at the options that are available so that they can bring it down to a more simple conversation and have the information that they need to make a decision.
No, super helpful. And let's dive into some of the complexity here for a second, because I think that's the fun we have on the podcast here is we kind of talk through some of these things in a little more detail. So I know there's terms and concepts such as market to book ratios, put provisions, wrap insurance, So as I kind of say a few of those terms, can you maybe just provide us with a functional definition that somebody could walk away with and say, oh, okay, I now understand, or I now get what those terms mean, and maybe what the significance or what the impact that they might have on stable value funds?
Sure. So there are several different types of stable value funds. We've sort of used the word stable value more general these days, much like large cap growth or small cap value. But inside of that are different structures. So you have a general account funds, and what that means is that the investor is investing in a general account of an insurance company. And typically those are wrapped, and when I say wrapped, that means the insurer is insuring the guarantees, usually by that insurance company. We call that a single wrap. So there's one insurer, and so we call that single wrap, providing all the guarantees. And general accounts typically are a stated rate. So I'm going to pay you X for a certain period of time. And the insurance company is taking on the liability and the risk, hoping that they're going to outperform what they have promised. And then you've got separate accounts. And separate accounts typically fall outside of the general account. So you're not investing in that insurance company's general account fund. Performance is based on the underlying assets. And there's usually an investment policy statement. Many times, individual separate accounts are designed for much larger companies. And that can be wrapped by an individual bank or insurance company, or there could be multiple. So you could have, let's say, 5 different insurers, and they're insuring a certain sleeve of that fund. And then you have commingled separate accounts. And so those are many, many different plan sponsors are providing this fund to their participants. So there's many participants joining into this commingled pooled separate account. And again, that can be single wrap, multi-wrap. And then all of them have, you mentioned a few buzzwords out there. So market value to book value. And some of the big things to really look at is termination provisions, for instance. So if your plan decides they want to leave or they're changing record keepers, things to think about are, is the fund portable? So can I move from this record keeper and move my fund over to this new record keeper without any disruption? So portability is really huge. And then based on the market environment, you could have a market value that is below what your book value is. And so it's really important to look at terms about, am I only allowed to get out at market value? Because if I need to leave the fund, I could have a negative impact if there's not what we call a put provision. So I always say puts are good. Some people have a negative feeling about puts, but puts are there to pay out over time the participant's money at a book value, so there is no loss. And it protects not only those participants, but the existing participants in the fund and the fund itself. So hopefully that answered your question.
No, super helpful. And I don't know, one thing I've always gotten a little tongue-tied on is providing kind of a working definition of wrap insurance. So I guess if you had to explain that to someone for the first time, how would you define or how would you explain the benefit or the function of wrap insurance in managing or running a stable value fund?
So wraps are there to provide assurance for principal and interest for the participant. And probably the easiest way to explain it is if you have a multi-wrap fund, let's say you have 5 insurers. They can be banks or insurance companies. And they are taking on a specific sleeve of the fund. And those are very highly negotiated contracts between the insurer and the fund itself. And they are creating provisions in an investment policy statement. For instance, you can only hold, or we want you to hold a certain amount of cash, or you have to sell a bond if it gets downgraded at a specific time. So there's some restrictions around what they can do because, the insurer wants to be comfortable with how the fund is being managed. And if you have a single wrap provider, one insurance company, same thing, they're providing those guarantees of no loss of principal or interest. Many times your contract with that, because it's your own investment team managing the money, you might see less restrictions on how that happens. And in a multi-wrap fund, so sometimes there's this perception that there's diversification of risk because I've got 5 companies providing my guarantees. Well, not all the time does it mean that if one decides, we don't want to do this anymore, and so we're going to exit the business, and now we've got a gap, that doesn't mean the other 4 come in with a safety net. They may, depending on how the contract's written, but many times it means that fund has to go out and find somebody else that's going to be willing to take on that sleeve and provide those guarantees.
And the guarantee being that if something happens to the company or the portfolio, that they're going to stand behind the book value of the portfolio. Is that what the wrap insurance is doing, or is there some other function or guarantee that wrap insurance is providing?
Yes, so it's guaranteeing no loss to the participant versus like we talked about. So for instance, many stable value funds have what we call a floor. So they guarantee that you can never earn less than 0%, or some floors, are somewhere between 1% and 3%, which means that the participant can't lose anything less. So versus what we talked about earlier was, money market right now is hovering so low that they can actually earn a negative rate because of expenses, unless the fund company is willing to forego the expenses during these tough times.
Got it. So I guess to put a closing point on wrap insurance, that provides some of the extra guarantees and protections that you kind of talked about at the very beginning, and that's sort of one of the mechanisms that helps bring those to life when you've got a very dynamic portfolio, which Ken, we'll talk about that in a minute here, of securities, that this wrap protection sort of, not to use the analogy there, right, or whatever, but wraps all that in a nice warm blanket and says, okay, even though there's some risk in the portfolio to get that extra yield, it's going to kind of wrap it all together so that it's more stable. There's more protection. There's more guarantees. There's more consistency to it from the participant perspective. Fair?
Yes. Very fair.
Okay.
Perfect.
And I guess maybe one or two last thoughts, and then we'll kind of kick over to Ken here. As you think about other things going on in the world of stable value or money market, what are some of the things that employers should be thinking about, or trends that they should be considering as they're either evaluating their stable value funds or kind of having those thoughts about cash equivalents and things of that nature in their workplace retirement plans?
So I would say there's a few trends going on right now. And in addition to just, things that you look at when you are selecting a mutual fund also need to be looked at when you're selecting a capital preservation fund. So, looking at fees, and fees can have management expenses, and also you want to look at what the wrap costs are, because those can vary greatly. Obviously, you want to look at historical performance and how the fund has performed over time, and then the construction of the portfolio based on what's going on in the marketplace. But I think even more generally, we're seeing trends where it's almost an extension of the record keeping platform. And so they go with the proprietary option. So looking at, okay, how does that look and how does that work for my plan? So many times a record keeper is going to offer a discount on the record keeping cost if you use their proprietary stable value fund. So you really have to weigh out, okay, it doesn't mean it's a better fund. So looking at your other options and determining, okay, is this cost savings worth selecting based on this type of fund that they're offering? And then I would say the other thing, because of this compressed fee environment that we're in, some funds have 3% guarantees, and you really want to be asking the question, how much of your business is offering a 3% guarantee? Because that is going to put a lot of pressure on that fund company to maintain that. It's unsustainable in this environment. So they're either going to have some pretty uncomfortable conversations with their plan sponsors about reducing that 3% guarantee, or they might start to see some funds do soft closes and not be able to accept new business. So I think those are important things to be talking about today.
Super helpful. Thank you for sharing that and kind of covering some of the basics there. Ken, I'm going to pivot over to you, and I think Debbie hinted at that with just where we are in the interest rate environment. And, you know, as we've talked a little bit about the basics of stable value funds, where essentially they're a collection of fixed income investments, where we are today at, let's call them historic lows. And I don't know, maybe there's a better word to describe the interest rate environment, because I feel like we've been saying we're in historically low interest rates for the last decade now. So I'm not sure how much longer you can really say that without coming up with a new term. But how does a manager think about generating yield when nearly all major interest rates are under 1%?
Yeah, I think, Rick, the issue today that you face as a fixed income manager obviously is predominantly driven by where interest rates are. But, I think when you, and Debbie alluded to this before, when you think about what money market portfolios are able to do, they're very limited in the securities that they can buy. And that's by design, right? They don't want duration exposure. They don't want extended amount of credit risk because it is a capital preservation fund. And so a stable value fund allows portfolio managers to really emphasize different sectors, different ranges of maturities. And there's a wide purview of ability to move into different sorts of securities away from short duration money market like securities, whether it be investment grade corporate bonds, mortgage-backed securities, commercial mortgage-backed securities, asset-backed securities. They're all opportunities to highlight where the manager thinks there's the most value. And so there's two components to your yield profile: the yield of the underlying benchmark, i.e. your treasury security. And again, I would say that you're absolutely correct. We are at historically low interest rates, and I totally agree with you. We might be saying that for some time. But the other component is the risk, the credit risk that's associated with those sectors that I just mentioned. And the spread, or the difference that you earn for taking that credit risk above and beyond your treasury security or your benchmark reference rate. And so those will compress and expand given what's taking place. And so I think that, investors, when they think about just yields and what yields look like in terms of the historic lows, sometimes they miss the component where there's another portion of your exposure or your credit risk that you're taking, either credit or duration risk, that's compensating you above and beyond that treasury security. So, and that's what we're able to do, or all portfolio managers are able to do in this environment, emphasize those sectors in which you're getting compensated appropriately for the credit or duration risk that the manager is taking.
We're starting to see this. I don't know. As a visually looking at some of the rates out in the world right now, it seems like rates are starting to tick up a little off of the lows. Do all of these, let's call them strategies, do all of these, the credit risk, the duration risk you just talked about, do all of those assumptions or strategies work if we see at some point in time, interest rates start to tick back up. Does that help, or does that hurt, or provide a headwind as you're thinking about generating yield in a stable value portfolio?
Sure. And I think the comment I'll make is, probably relevant not only for stable value funds, but really for all fixed income funds. Essentially, it's rising rates are not necessarily a bad thing, especially for fixed income managers, right? We want to be able to generate more current income for the participants in the portfolio. What I think is probably more harmful for fixed income managers if it's a violent move higher in rates or a violent move higher in credit spreads over a very compressed short period of time. We saw that in spreads in March of this year, brought upon by the pandemic. There was something, several years ago called the taper tantrum, really driven by the Fed's indication of removing support for the mortgage-backed security market, as well as treasuries. And we saw rates rapidly rise over a very short amount of time. And so each fixed income or stable value portfolio will react differently in those conditions based upon not only their duration, but also the amount of credit exposure in their funds. And so to Debbie's point, I think not only do you need to be aware of the nuts and bolts of how stable value funds work, but also, the transparency of the underlying securities and the duration and credit exposure that those stable value funds, to understand how your crediting rate and your market to book will react in those certain instances. So a little bit of a idiosyncratic response by each portfolio, again, given duration and credit exposure in those differing interest rate environments.
All right. Let me ask if this is too simplistic. I'm assuming it is, but I'll ask it anyways. When looking at things like duration in a stable value portfolio, so I'm looking at two different providers. One's duration is, I don't know, I'm just going to make stuff up, 2.5 years. Another's duration is 5 years. If rates start to rise, is it a accurate assumption to say that if I have lower duration, I would participate in the rising interest rate environment more favorably, or that would work more favorably for my portfolio because of my duration? Whereas with longer duration, that's going to be, that potentially has a more negative effect on my overall stable value portfolio and an ability to generate competitive yields as interest rates rise. Is that too simplistic, or did I at least maybe catch a piece of that some of the nuances around duration?
No, I think you did a great job of catching the piece. So maybe I'll dig a little bit deeper into terms of how those two portfolios might react. So in a rising rate environment, let's take the portfolio that has a 2.5-year duration. That portfolio, again, is going to be receiving cash flows from their current holdings. They're going to have more cash flow coming off on a normal basis than the 5-year duration portfolio,
because bonds mature and you have to reinvest as they mature.
Absolutely. So you're getting cash flow quicker than the 5-year duration portfolio. And what happens is, as rates are rising, you're reinvesting the proceeds and the roll off from your current portfolio at ever increasing interest rates. And so your crediting rate might see a quicker increase in your crediting rate than the 5-year duration portfolio that's not getting those cash flows as quickly as the shorter duration. The second component I would say that's important as well is your market to book ratio, because you have lower interest rate exposure in a rising rate environment, will see a lesser impact to your market to book than the 5-year duration, right? That 5-year duration portfolio has more interest rate risk. And so the holdings on a market value basis in that 5-year duration portfolio in a rising rate environment will experience steeper price declines than the shorter duration portfolio. So you're right, but that's how those two portfolios would react in terms of crediting rate as well as the market to book.
Conversely, in the opposite scenario where you have declining interest rates, the longer duration is a tailwind, and I think that's what we've seen with a lot of stable value portfolios out there in the market right now, is we've seen kind of this overall macro decline. Some of the best yields in stable value have been with those funds that have longer durations, 5-7 years, somewhere in that general vicinity. Is that, again, agree, disagree?
No, you're absolutely right. So, I think as a fixed income manager, duration has always been the biggest concern, because that's what, is going to be really impactful for your portfolio and that interest rate sensitivity that you have. But oftentimes that we've seen in the last several years, due to the, overwhelming support from a monetary standpoint from central banks across the globe, including the Federal Reserve, they've pushed rates extremely low and have kept them low. So as a fixed income manager, duration has been, quote unquote, your friend for the last several years. Why is that? Well, because again, more interest rate sensitivity in a declining interest rate environment will boost your market to book. But also, you invested, several quarters ago at higher rates, and you're not getting roll off as quickly as the shorter duration portfolio. So that shorter duration portfolio that has a 2.5-year duration in a declining interest rate environment is getting those cash flows quicker, and they're having to reinvest at those ever declining interest rates. So again, very interesting dynamics that you see. But again, fixed income managers have several levers that they can pull. Duration is one tool that they can use, but also the asset allocation as it pertains to other sectors, and emphasizing your asset allocation and security selection is another way in which you can de-emphasize just using duration. You want to be well diversified and able to build a well diversified portfolio that takes advantage of certain spread environments, not just interest rates itself.
Let's hit on the diversification thing for a second, because I think historically I've heard some people describe a stable value fund as, hey, think about it as a high quality intermediate term bond portfolio that has these wrap contracts and wrap characteristics to kind of even out some of the bumps in the road as you see kind of market events or movements up and down in the interest rate environment. So obviously what I'm saying there, hey, intermediate term, high quality bond portfolio, that's a very plain vanilla description. So in reality, what's really going on within a lot of stable value fund portfolios? Is there a lot of diversification between high quality, maybe high yield or quote unquote junk bonds, or what does that look like actually?
Yeah, so I think, Debbie alluded to this earlier in her discussion. Not all stable value funds are exactly alike. So depending upon the provider or the manager, and as well as the wrap provider, understanding the guidelines of the underlying portfolio is important. Some managers manage versus a benchmark, and they want to make sure that they're tracking the benchmark to some extent, and they'll take positions, whether it be overweight mortgage-backed securities, underweight corporate bonds. So they'll take advantage of different sector allocations in order to, generate what they deem to be an appropriate crediting rate or yield to maturity for the underlying portfolio. I think, by and large, again, the transparency of looking under the hood is where it really becomes important. Understanding the manager's ability to manage through different cycles in order to select those securities that will, not move from investment grade rated securities to below investment grade rated securities. And so I think, understanding the portfolio manager's experience in terms of managing assets through a cycle and how they adjust their portfolio in those different environments is really important. And certainly you don't want to have a portfolio that's, taking outsized risk in one certain area, whether that be, managing a fund at the maximum level of duration, or in terms of their asset allocation, putting all, bad analogy, but all their eggs in one basket. I think, managers that have the ability to shift their focus and exposure as the environment changes is really important to understand.
As you talk through all that, the thing that I think also plays into some of these conversations is the market to book ratio, as we alluded to a little bit in the first part. And I guess when you think through that, does your current market to book ratio, does that in some way dictate allocation or diversification decisions, or are those completely separated?
I think the market to book, in my mind, is probably more important and relevant for, the individuals and advisors that are doing their due diligence on certain portfolios. Because I think what you want to understand is, and again, Debbie did a nice job of positioning how the wrap works. And, again, not all wraps are created equally. You have single provider wraps, you have multi-provider wraps, and those work differently. And so understand the underlying credit quality of those wrap providers is going to make a difference on how you view your market to book. Essentially, lower credit quality wrap providers that have a lower market to book, one might think that that's not an attractive proposition just because of their ability to make good on the guarantees that they offer. Certainly, as a portfolio manager, we're well aware of where our market to book is currently trading. And there's different things that we can do or managers can do in order to improve, in certain instances, the market to book of a certain portfolio. And so we're well aware of those instances. And when we see an opportunity or a portfolio manager sees an opportunity, and to your point, Rick, earlier, if a manager has a view of rates declining, they can extend duration and take advantage of declining rates that will increase the market value of the underlying securities and thereby improving the market to book value of that portfolio.
Sorry, just because I think the market to book thing is really a fascinating conversation. So let's just say, let's take the bad side of market to book, or at least what I would perceive to be the bad side of market to book, which is, and I'll use an extreme example. Hey, our market to book ratio, meaning the current market value of the securities to what the value that's being shown in a participant's account, is 90 cents on the dollar. So you have a 90% market to book ratio. Does that start to make you think differently, or is it, hey, that's just a data point and it's full steam ahead with whatever strategy we've employed, assuming that strategy is still current, relevant, acceptable in the broader market?
Yeah, that's a great question. And so I think it comes back to the due diligence of advisors and those individuals that are tasked with finding out the most appropriate vehicles. Because to Debbie's earlier point, the discontinuation clauses or the put clauses that each portfolio has are extremely important to understand, and how that might affect that significantly reduced market to book. Because certainly in that environment, if there is no put provision that elongates the outflow, what I think really would be sort of disadvantageous for current holders of a certain portfolio at a 90% market to book is if there's a large outflow and there's no put that has it over a certain amount of time. It's just on, day zero, and you can take the assets. And so that's going to be detrimental to, the participants. So understanding the out clauses as well as the put provisions, I think you have to marry that or look at that in the same lens as where the market to book of the portfolio is trading. And so again, as someone that's doing due diligence and speaking to advisors, that's the really important aspect of the market to book, and understanding what it's looked like in history, and has it increased and decreased? Is it volatile, or is that market to book relatively stable? And certainly, I think that would be beneficial for participants and advisors to see.
I want to put a pin in the put thing for a second because I want to come back to that, but let me take the plus side of this is, hey, our market to book ratio is 103.5. And I think for some people, oh, that's great. Is that really a good thing to kind of run with higher market to book, or do you want to try to keep it as close to 100 or, even between market to book as possible?
Yeah, I don't think it's, I can't say that, it would be beneficial to manage it to 100 cents on the dollar. I think, oftentimes there are things that happen in certain environments that, quite frankly, just think about the decline in interest rates that we've seen over the course of the past several quarters or really the last decade, we've seen declining interest rates. The portfolio, whether it be stable value or fixed income portfolios, are going to react to that environment. And so I think understanding your duration risk and how that might potentially affect your market to book is important. But certainly I don't think it's one in which there's advantages to managing the portfolio to be exactly, par. I think, obviously what you want to protect against is a significant decline in your market to book. And so again, what do fixed income managers want to avoid? Extended duration sensitivity when rates are rising quickly. They want to avoid declining credit quality, i.e. credits going from single A to triple B or triple B to below investment grade. What's that going to do? Prices of those bonds are going to come down and obviously be detrimental to the market to book. And so those are the things that, again, whether it be stable value or fixed income, regular way fixed income portfolios, that's really what portfolio managers want to avoid.
No, super helpful. Coming back to the put provision, and I think Debbie said it well, a put can be your friend. I think for a long time, I looked at that in the opposite way, which is like, you've got a 12-month put, a 24-month put, or 5-year put, whatever it is, on a stable value, and that's a major disadvantage to a stable value fund. But I think as my thinking and understanding of stable value funds has evolved over the years, I think there can be a lot of advantages that a put brings, even though on the surface it seems really bad in that, oh my gosh, if you change stable value providers or for whatever reason you have to liquidate the funds within the stable value, there's the potential that this put's enforced. Give me the argument for how a put helps a portfolio manager manage what's going on in the stable value fund, and it can be good for investors in that particular strategy or fund.
Yeah, absolutely. And so the way I would think about it is, and Debbie touched on this before, is, and even in regards to what you just said, Rick, if that put is, let's just say, over 12 months, and you have a pool of assets and, one participant decides to leave the fund, and they're relatively substantial portion of that fund, the put is going to protect the current owners of that fund. So as an advisor, that would really be important to me to understand. I want to make sure that I'm protecting my plan participants from the actions of other plan participants, right? So if there's an outflow due to a plan leaving the fund and they're put over 12 months, well, the portfolio manager is not forced to liquidate positions to meet that immediate redemption. And so that gives the portfolio manager the ability to either let roll off of your current positions or principal and interest, start to build a cash position in the portfolio that will meet those redemptions that are elongated over 12 months. And so it really insulates the current owners of that fund from actions of those that might be leaving the fund. And it helps the portfolio manager mitigate any sort of, one point in time, right? In terms of if markets are declining in terms of price or rates are rising quickly, they're not selling at inopportune times that would potentially hurt the current owners of that fund. So it enables the fund to be much less, impacted by significant outflows. And so again, if you think about how mutual funds or ETFs work, that's immediate liquidity. And there could be liquidity events in those funds that will be detrimental to the current owners, certainly in performance, based upon the given environment.
And is this too loose of a description that the longer the put is, the more investment flexibility a manager might have within a stable value environment? Or again, is that too loose of a description?
I think it's relative. I could say that because again, it depends upon the size of the fund, the size of the redemption that one needs to meet. Quite frankly, there could be redemption and the manager is, not really impacted at all, even though that's going to be put over 12 or 24 months, and they don't need to, significantly adjust their portfolio strategy. So it'll depend upon what the outflow or what the redemption looks like, and certainly the environment, right? And oftentimes managers will take into account what the redemption looks like, and certainly over 24 months, one might say that's not going to impact the day-to-day procedures or processes that we use as a fixed income manager. If it's over 3 months, then, given the size of that redemption or exit from the fund, could that impact how it works? Yeah, it could certainly impact, again, given, based upon the environment. And again, I think this year more than ever, it's important to understand how these triggers work and how a fixed income manager might need to meet those redemptions based upon the current market environment.
Yeah, and just to echo your point there, I think the concept of the put provisions and these provisions being enforced, really, they haven't come into play over the last few years. As we sit here at the end of 2020, kind of talking through this, just my observations have been just with the macro decline in interest rates. If you need to redeem or pull money out of a stable value fund at a plan level, whether it's due to you're changing providers, you're changing record keepers, you're terminating the plan, whatever. There really hasn't been any enforcement of the puts on a broad basis out in the market. However, I think, and Ken, I think this is kind of where you were going with this is, if and when interest rates start to rise, that is a little bit of a trickier environment and brings in a little bit more risk around that market to book. And that's where a manager would probably be more likely to say, hey, we're going to enforce this put provision, whether it's 12 months or 24 months or whatever it is, and protect the portfolio, protect the investors in the portfolio, and still return money back at book value. But we're going to take the time to make sure we're doing the right thing by the overall portfolio.
Yeah, without a doubt. I think you prefaced that exactly right. I think the flexibility of those puts, again, to your point, certainly less impactful in this rate environment. But as we sit here, no one knows when rates are going to move higher. Having that put provision, will be a potentially an important tool for those managers to protect the underlying participants. And again, depending upon how the portfolio is positioned, their duration exposure, as well as if that move in rates is 5 basis points a quarter, that's not going to be significantly impactful. But if we get sort of that quote unquote taper tantrum, that will certainly be impactful for the underlying, and certainly will bring those put provisions to light at that point in time.
So as you look at interest rates, and we get this question a lot, I would imagine you get it even more. What do you see in the near future? And I guess as you think through that, is there a chance we get to negative rates? Are we? Anyways, would just love your thoughts there, and maybe interject a little on the on this whole concept of negative rates, which is like, I think as a prior guest said, it's the upside down. So that an interesting concept among itself.
Yes. For sure. I think, negative rates as a fixed income portfolio manager is so foreign, right? I mean, we've never been in that environment. Certainly there's parts of Europe that have endured negative rates for quite some time. And so it is an extremely, upside down proposition as a fixed income manager. But, I think, Rick, when we look at what the Federal Reserve has said and really communicated to the market over the past several quarters, if not years, is one of accommodation, and I think, everything that the Federal Reserve has said this year is they are going to be in an extremely accommodative stance until we are well through this pandemic, well through the recession that we experienced due to the pandemic, and well on our way to a recovery. So when you look at what the Federal Reserve has pointed to, whether it be their inflation target of 2%, which they've failed to reach in the past decade, one can assume that, and they've explicitly said in their summary of economic projections, they don't anticipate federal funds, their monetary policy rates, to move off the zero lower bound of 0 to 25 basis points until at least 2023. Granted, things could certainly change. Could we come through this quicker? Could we reach those inflation targets quicker? Certainly that's possible, but I don't think that's their base case scenario. So one would have to assume that federal funds and the short end of the interest rate market is likely to be tethered because that's what the Federal Reserve wants. Now, in regards to negative rates, I think we have to delineate what we think about in terms of negative rates. So what I mean by that is monetary policy rates are a tool that the Federal Reserve as well as central banks use to pump liquidity into the system. And so one of the tools that the European central banks have used is negative rate policy. They've taken their deposit rates or their monetary policy rates below zero. The Federal Reserve has actually cited the fact that they don't believe that's an appropriate monetary policy tool, and they've indicated that in multiple instances. And so they were comfortable going to the zero lower bound, and their forward communication of maintaining that level for quite some time, all while engaging in asset purchases, whether it be through treasuries, mortgages, and now even corporate bonds. They have still maintained their stance of not wanting to use negative monetary policy rates because they don't think that has as much of an effect on the economy and the liquidity in the system as the tools that you're using today. Now, that being said, we are at extremely low rates. So one could look at the interest rate environment, especially in the front end of the curve, and could, T-bills or 1 or 2 year treasuries trade negative in an extremely risk-off type of environment? Nobody can say that that's not possible. So I think that the jury is still out on that, so to speak. But I think the Federal Reserve has indicated time and again that they're not willing to use negative rates at this point in time. But I think, again, we'll have to just continue to monitor the effects of this pandemic and sort of the black swan events, if you will, that could put downward pressure on the front end of the interest rate curve and ultimately, put rates below zero.
So you mentioned COVID, and I guess as you think about that and as where we are at the, kind of coming into the close of 2020, as you look out and as you kind of digest some things that have gone on this year, what do you think that means for fixed income investing in 2021 or beyond? Are there major changes coming? Are there things that employers should be thinking about? Does this mean different things going forward? Or I don't know. Well, what do you see kind of coming down the pipe as you look into your crystal ball?
Yeah, I wish I had a crystal ball, but I think we all do. I would probably say the most impactful scenario that we dealt with this year is obviously COVID, but the knock-on effects from that have been the overwhelming monetary support from the Federal Reserve has been just, nothing short of historic. If you think back to 2008, 2009 and the financial crisis, the Federal Reserve responded appropriately, at that point in time, given what was transpiring. But the timing of that took a while. It was over the course of several months where they implemented some of the emergency tools to stem the unwind of financial assets in 08, 09. Well, if you fast forward to what happened in March, the Federal Reserve was extremely reactive to the situation at hand. And they used the toolbox that they had in a significant way, one in which the markets have never seen before. And so I think that that's been the most impactful sort of scenario to fixed income investing this year. And again, I think as we look to the out years, I would probably point back to my earlier comments that the Fed has indicated their overly dovish stance, their indication to keep rates low, to keep buying treasuries and mortgage-backed securities, keeping these emergency lending facilities intact to make sure that the economy has the best chance to get back to where it was before based upon price or inflation, as well as employment. So, we've obviously seen a significant decline in the amount of employed people in the United States. And that's one of the Federal Reserve's main goals and objectives is full employment. So they're going to be monitoring the unemployment backdrop in the United States for the next several quarters, if not years. And if they don't meet those goals, they won't move off their zero lower bound. So I think you and others, and certainly we've heard this and we use it in the fixed income world, this lower for longer mantra is one that's been used on a relatively frequent basis. But I do think that you have to also think about the other side of the coin. We are seeing an election in just under 2 weeks. You're going to have a new administration or an existing administration back in. You're going to be dealing with a different makeup of Congress and Senate potentially. And so those policies that are instituted in the future will certainly have an impact on where interest rates are. And I would close by also saying that a lot of what we talk about in stable value is based on the front end of the curve and certainly money markets, how they react to Fed funds rates. The shape of the yield curve is another thing to consider. And so the shape of the yield curve could change. It could flatten, it could steepen based upon what the Federal Reserve is doing and also what policies are coming into place depending upon which administration ultimately wins the presidency as well as the Senate. So a lot of moving parts, a lot of moving pieces, and only time will tell exactly where things shake out. But I believe that the Federal Reserve has made it abundantly clear that they're willing to be extremely accommodative to support the economic rebound, that I think we all want so badly.
No, very well said. And we've covered a ton of ground today and really appreciate the time that you and Debbie have spent talking through stable value and some of the more nuancy aspects of it. Is there anything that we've missed or anything that we should mention before we wrap up?
Yeah, Rick, I think we touched on all the relevant topics. I think from my standpoint, and Debbie did a great job of, really what you should be thinking about in stable value is doing your due diligence and understanding the structures and all the nuances. So, really trying to engage in conversations with professionals in the stable value world in order to provide the best service and product for the plan participants that you serve is really important. And especially more than ever in this low rate environment, I think capital preservation strategies look vastly different today than they did in years past. And so I think understanding the stable value opportunities that exist out there are certainly something that should be discussed. And podcasts like this, I hope, advisors and plan participants will get a lot out of. So I appreciate you having me today, and certainly was really nice to chat and discuss these topics.
No, excellent. I would agree, and thank you for being here. And hey, if people take nothing else from this other than you can't just look at stable value based on yield, then I think we've gotten at least part of the message across.
Absolutely.
All right. Well, Debbie, Ken, thank you so much for being here. Thanks for the time, and certainly as we delve into this topic in the future, would love to have you back.
Great. Thanks so much, Rick.
Be well.
And there you have it. Debbie Vince, Ken Sommers with New York Life. Really good stuff about stable value funds. I hope you got as much out of it as I did, and hope that gave you some great thoughts around how stable value funds work and how to evaluate some of the different characteristics, features, etc. that stable value funds have. Coming up on the podcast, we have some more fun conversations talking about small plans. We're going to do another episode of really one of our kind of, let's call it, favorite episodes out there, where we do jumbled gibberish or jargon. So that's always a good conversation with JD Carlson. And as we go into 2021, definitely am looking for ideas and suggestions on new podcast topics to tackle, or just others that maybe you'd like to get a little refresher on. So shoot me an email to feedback@401kfridays.com, whether that's with a topic, a specific question, a guest, or an idea, and we'll take it from there. That's it for today. Until next time, I hope you make your Friday a 401k Friday. And now, for some disclosures. The content in this podcast is provided for educational and discussion purposes only. Investing involves risk, including a potential loss of investment. Lockton does not and cannot guarantee the future performance or specific level of performance, the success of any investment, or success of any strategy. Nothing contained herein may be construed as investment or legal advice.